Okay, here's the review you usually have to wait till the end for. We do the economy, we do the markets, this is global. This was the title of the September talk, it's the title of the October talk also. The September meeting was 9 o'clock in the morning in some hotel downtown, so most people couldn't, even I almost didn't show up. They made me show up, so I had to come. But you're like, that's how, 9 o'clock in the morning on a Saturday, I can't imagine anything. Well, 9 o'clock on Sunday would be worse, okay, that's one worse thing. So, I'm not a morning person. Okay, as I said, the contents of this presentation are not intended as a recommendation, so forth and so on. That's all legal disclaimer, and it has nothing to do with anything New York Life thinks. And, okay, so here's some like, this is like the important news comes first. Bernanke, who was the Fed chair during the crisis in 2008, just before until last couple of years, released a book called Courage to Act. This has been a great source of comedy over the internet, especially Twitter. So this was a suggested cover for the book that sort of like didn't get to the press at the end. Notice it says he's printing money, it says Speedy Quick, Federal Reserve. Okay, it's not making this audience. And here's like an excerpt from the book, explains quantitative easing. Many people hear this, they don't know what it is. You know, you feed the banks lots of money, something eventually happens. So, like, you know, just in case you don't need to read the book after this. There's also a children's version, business fairy tales, and then Mr. Bernanke took his big axe and chased the evil subprime bear back into the woods. And that little kid is looking up. So, okay, there's also a porno version, 50 Shades of Money, you know, and there he is in his, like, favorite costume, and that's, like, an inflatable object. I don't want to get into that. You know, Memoir of a Keynesian Bubble Maestro, that, like, actually, that's pretty pornographic. Yeah. So, okay. Mentions in Bernanke book, I left out the most famous one. The things he didn't mention, there's dozens and dozens of Bernanke quotes where he said stupid things and he had no idea what was going on. And the one I forgot to put at the end, his most famous quote is subprime is contained, and that was in June 2007, just before everything started to blow up. You know, he gave this major speech, oh, everything's terrific and wonderful. Within a month, 6 weeks, like the market started tanking, and one disaster after another started happening, and it went on for like 2 years. So that's like that's always dragged out. So that should be down here. Imagine it down here. And then like there's dozens of other quotes. The 6th of June 2008, before the big collapse happened in September, you know, the rest of the economy has entered a substantial downturn that appears to have diminished over the past month or so. No, it was actually accelerating into a massive like blow up. So clueless. I mean, one thing after another shows he's clueless. July 2008, even worse. Fannie and Freddie, this is Fannie Mae and Freddie Mac. These are the big government mortgage companies, are adequately capitalized. They're in no danger of failing. They actually didn't fail 2 months later, they failed right at that point. I think that's the date of the failure. You know, I copied this or something. And we actually predicted they would fail. We predicted almost every failure, not just that it would happen, but we also predicted it will happen now, or it will happen soon. You know, when Bear Stearns, we actually predicted Bear Stearns would go under, and then when it did, people say, oh, Lehman's going to go under. I said, no, it will go under, but not yet. And it went under in September. So, like, we actually got just what happened, but that the timing of what happened pretty accurately. So, this will not play, unfortunately. This actually is a video that's here. And I wanted to play this as like a part of our political summary. You're going to hear more and more about politics. Politics affects the markets, and it's going to affect the rest of our life. Who gets elected president and the entire presidential election. And this is a very heated election already, and it's not for another year, more than a year, actually. And so I'll explain this video. Boehner resigned. It's very unusual he's the Speaker of the House, a very powerful person. And in fact, he's third in line for president, keep this in mind, so he's not like a nobody. And like, he resigned mysteriously, and you know, a few weeks ago. And it's not so mysterious, he actually lost support in his own party, and effectively they turned a vote that was coming up into a vote of confidence, which we have in parliamentary systems, but we don't have here. So he was basically forced out. You know, he didn't like resign to spend more time with his family like they would be saying. Now what happened, this video was like Marco Rubio is one of the presidential candidates, is speaking to a group of conservative Republicans. Now it's all Republicans, there's no Democrats in this group. And he announced it, suddenly the news comes out, he said, oh wait, Speaker Bonner just resigned. And what do you think happened? Yeah! Exactly. Not only did they start applauding and cheering, they gave it a standing ovation. And these are Republicans, not Democrats. So there's a huge split within the Republican Party. The leadership doesn't really represent the base or anyone under them. And Rubio is standing there going like, oh my God. And he like had to, you know, get his composure back. Like, you know, he was totally shocked by this reaction. And he obviously was like upset Boehner resigned. Now he claims to be anti-establishment, obviously he's not at all. But the shock is that these are the hardcore Republicans, and they couldn't have been happier if Boehner was leaving. So there's been a complete loss of confidence of the leadership, and there's a major split within the Republican Party. So, and this was visually showed it quite well. So next time we'll try to actually get a video to work. It's the first time I actually put in a video. So, and we'll talk more about the presidential election as it goes on. How many people saw the Democratic debate the other night? Okay. And how many people saw the one of the Republican debates? Okay. We just say, like, what do you think? But that might start a fight. I saw part of the Democratic debate, and I was like so shocked and horrified. I thought I was watching some communist film from like Soviet Russia, 1950. You know, I just heard spin. We have this free program, this free program, this free program. Like, how are they going to pay for all those free programs? Well, maybe we'll find out. So as we go along, we'll find out. Anyway, the U.S. economy is deteriorating, and not just the U.S. economy, the global economy. And we're going to have the third quarter numbers will come out very end of October, 10 days maybe, somewhere around the 31st. And the average estimate now is GDP is only going to grow 1.7%. Now, 3% is good. So 1.7% is very mediocre. And that's not the low estimate, that's the average. The low is around 1% or even less. And there's some major Wall Street banks at that 1%. So that's very, very weak. And this is after 6 years, actually 7 years, of quantitative easing and 0% interest rates, which are supposed to rev up the economy and fix everything. You know, and at 7 years, we're facing another recession, actually, after all of this, which shows how well it all works. The Japanese have done the same thing since late 1990s, and their economy has never recovered, so it's at least 16 years for them. So we do these things saying, oh, you know, it never worked in Japan, it's going to work here. No, it's not working here either, and it never will. The jobs that were supposedly created in September were 142,000. That's not good. You need like 250, 300. The average last year was 260,000, so you see how low that is compared to a year ago. Not in labor force. I was one of the first people to write about this issue several years ago. Since the recession began, there are now 94.6 million people not in labor force. That means they don't work, they're not looking for work. And when the recession began in December 2007, that number was 79.3 million. So it's grown. 15 million people have left the labor force since the beginning of that recession. Now, there's never been a case where the labor force has shrunk during a recovery. And it not only has shrunk during this quote recovery, but it shrunk massively. Now, these people are not counted as unemployed. So even if they don't have a job, but they're not counted as unemployed. So the unemployment rate is like, this is like 5%. It's extremely unrealistic. You know, somewhere around 12% is a more realistic number. This is just a statistical quirk that lets the government, you know, get away with saying, hey, things are great. Retail sales, which is the biggest part of the U.S. economy, those numbers, September numbers came out yesterday saying, 0.1%. These are not adjusted for inflation, by the way. And last month was redone to make the number 0%. So no growth. And 0.1 is basically no growth also. And just 2 days ago, Walmart mourned when its earnings came out. The stock fell like 10%. Walmart is the biggest retailer in the United States by far, and you can use it as a proxy for the U.S. economy and retail sales. And it's like the numbers were disastrous. And they said, oh, it's going to get worse and worse and worse. So this is very recessionary looking. And then there's another statistic came out the same day. Business inventory to sales ratio was 1.37. What does that mean? It means not, inherently means nothing. The last two times it rose to that level were during recessions. So this is a recessionary number also. And I'm going to show you a graph in a second. There's also mortgage applications for housing are dropping. They've been dropping for months now. So real estate is weakening. The U.S. oil rig count is now at May 2002. This is a separate issue that doesn't have anything to do with recession. It has to do with the oil market, which we'll discuss more later. And the Fed did not raise interest rates. People thought they might in September. They didn't do it in October. They're not going to do it this year. And they're going to put it off and put it off and put it off. ZIRP means zero interest rate policy. We've had this since December 2008. Now there's certainly a joke in economics that, unlike love, ZIRP is forever. What's a modified from another? Well, it's actually true. Japan has had it for 16 years. They've never gotten off ZIRP. It's like the Roach Motel. And who remembers those Roach Motel commercials from 20 years ago, long ago? You're all too young. It was on TV, this highly annoying commercial. Some product to get rid of roaches, they go into this box and they can't get out of the box. And they kept repeating the announcement, they go in, but they can't get out. They go in, they can't get out. ZIRP is like, you start ZIRP, you can't get out of it. So it's like, and roaches are involved also, something like that. So here's the business inventory sales ratio. High is bad, low is good. Pink is recessions. You see, like it was the last recession, which was the worst recession since the Depression in the 1930s. This number really skyrocketed. We are now at the middle of that range. And that when the recession began last time, Jim is going to yell at me. We were down here, we're now all the way up there. Which means we may have already begun a recession. Sometimes we find out. In fact, the last recession, December 2007, we said that month in that meeting a recession is beginning. The government, a year later, in December 2008, said, oh, a recession began in 2007 in December. They should have just called us up. We could have told them. But, no one else heard about that for 1 year. So sometimes it can take more than a year before they say, oh, a recession began way back then. So here, mortgage applications, just at WF is Wells Fargo. You see, this is 2012, they're really high. You see, lately, they've gotten down, they're way, way lower. So the housing market is cooling off. Maybe not in New York City. Kelly will tell you about that later. New York is a very special housing market. You have to remember that. Here's the U.S. economic recovery summed up quite accurately. The recovery began in 2009. So the recession was 2007, 2008. The bottom is the percentage of Americans in the labor force that's dropped during the recovery. This never happened before, as I said. And the top is the number of people on food stamps. Well, if the recovery is doing so well, why are more and more people on food stamps? This indicates they don't have enough money to buy food. So both these things say the economy is not doing well. It's just getting worse and worse and worse. And we're really in some massive long-term recession that's being hidden. So here's the physical state of the U.S. We've been doing this since early 2008. When we started, that top number national debt was 9.1 trillion. 9.1. It's now 18.4. That's more than double, and that's from 2008 to 2015. So that's 7 years the debt's doubled. Now, you take out a piece of paper and take a number and double it every 7 years, and see what will happen like by the year 2100 or something. The debt will be like infinity or something. So I mean, there's incredible debt. And the U.S. is not the worst in the world. Japan is the worst in the world by far. We're pretty bad, but Japan is more than double our debt to GDP ratio. We also have state debt. Local debt, 3.1 trillion. The GDP is allegedly 18.1 trillion, but that calculation was changed about a couple of years ago. And you know, governments constantly do this. The European governments did the same thing. You know, they throw more things in and say, oh, why don't we count this and make the GDP look better? They never take things out to make it look worse. It's always a one-way street. So like England had 3 recessions, but they changed the GDP number. Something was 2. France had 2 recessions, something was 1. And they say, oh, look, we discovered we really didn't have these recessions. You know, this is just statistical manipulation. It's like a 5-year-old is doing it. So our debt to GDP ratio is supposedly 102. The GDP number is really a lot lower. Debt's actually much higher. Many foreign countries actually add the federal and state debt, local debt, to their calculations. So for the U.S., this would be 117% based on official numbers. Now, Greece got in trouble and started collapsing. It was at 120. Japan, however, is way over 200%, which shouldn't be possible, but it's happened so far. And that the economy hasn't totally collapsed yet, but it will one day. Unfunded liabilities, these are 99 trillion. This number is pretty arbitrary. It's a very huge number. What exactly is it? We don't know. National assets, that's the worth of everything in the United States, 118 trillion. So we have like 99 trillion unfunded liabilities. That's money we have to pay in the future. Well, we're broke. We owe all this money to someone. Total U.S. debt is around 65.4 trillion right now. That's money owed right now. Student loans is a disaster waiting to happen. The federal budget, a deficit came out for the year. Fiscal year is September 30th. It's 468 billion. Last year was 483 trillion. There's all this press like, oh, it's wonderful, terrific, great, great, great. These numbers were higher than anything that came before the last 8 years, though. We've not gotten back to the old numbers. We've just gotten back to the very high levels we started the Depression on. So there's a huge trade deficit. We won't find that final number for 2015 till March. And as we say each time, historically average interest rates would bankrupt the U.S. And that means like around 5%. So how are we doing for EU, Asia, there's a UK minor commodity trader, Glencore. There's a huge company. It had a massive meltdown. It looks like it's going to go bankrupt. This could like drag the whole market everywhere down with it. Socialists were re-elected in Greece. They had an election. So the bailout debt spiral continues. I've written a lot about Greece. They're on their 3rd official bailout. I maintain it's really the 4th bailout because the second one had 2 parts or some such thing. So each bailout, the economy's gotten worse and worse and worse and worse. So I mean, when you hear bailout, you should run away if someone offers one to you. So like the economy is totally collapsed in Greece, and it's just pouring more money just makes everything worse actually. So China has devalued its currency in the summer, and that caused that devaluation caused markets throughout the world to sell off. It was quite serious, and that was the trigger. Germany, the economy is in very bad shape. Germany is the economic engine for the whole of Europe. China for Asia. There's been a sharp decline in exports, and they're an export-based economy. Manufacturing orders have really fallen off a cliff. The huge scandal with Volkswagen. Volkswagen is going to be paying massive fines if it doesn't actually go out of business, which it could default. The government might take it over. So this is a big, big problem, and it's not going to go away just immediately. And Deutsche Bank, which is the biggest bank in Germany and in Europe, had massive losses at its earnings like a few days ago. So everything in Germany is not working out. And this is supposed to be the flagship economy of Europe. So like China's falling apart, Germany's falling apart, U.S. is like turning down. You know, it doesn't look good anywhere. Japanese on the verge of recession. We could actually put this in every slide every month. And you know, for the last 15 or 16 years or 20 years, wouldn't make any difference. Interestingly, that's been caused by a weakening emerging market economies because they're not buying anything from Japan. The Saudis, this is very important, are now saying the oil glut won't last. They have created the oil glut. So if they're saying this, that means they're not going to be pumping much as much oil as they have been. So this should raise both your eyebrows. Okay, let's quickly go through the charts. There's a massive global bond and stock bubble. You already know about this. This is actually from last time. Let's just look at the Dow. This is we mentioned this in the last meeting, but most people couldn't come because it was in the middle of the night. It's something we call a bear market pattern, which we judge whether or not stocks are in a bear market. And these colorful lines on the top of the chart are moving averages. The blue line is the 200-day. The yellow line is the 50-day, that's short. And the red line is 325-day, that's long. So 200 is in the middle. Now the bear market pattern is where that yellow line first falls below the blue line, and then it falls below the red line. And then the price trades below that red line continually. So this is the Dow, you see this has happened, and it's going above the yellow line, but still trading below that red line. So nothing, this indicates no recovery in the technicals. Markets go down, they go up, they don't go straight down. And then we're going to see in a second, that red circle, this number went below 20. It should never do that. That indicates really bad news. It's more bad news is coming. The circle on the bottom, that's actually the trend. That trend is dead. It's like an uptrend, but an uptrend is dead. So it says it's not going to continue. Now here's the same chart. This is the Dow again. We've had this rally. People who watch TV. Oh, we had a big rally and everything's wonderful. Blah blah. No, nothing's wonderful. Nothing terrific happened. And here's the rally, that green line on the top, and there's a volume on the bottom. You see, as the market went higher, the volume went lower and lower and lower and lower. Well, that's not supposed to happen. If the rally's good, the volume should go higher, higher, and higher. So it basically says to me this is probably short covering. That means the market was bad, people shorted stocks, they had to buy them back to cover. And so without the volume, that indicates they bought a lot of shorts back, there's nothing left to buy. So that means the rally doesn't continue. So this picture doesn't look good. The volume picture says, hey, the rally is not important. And you would see if we had volume for the other indices, you'd see the same thing. You notice the S&P has that same picture, that yellow line fell below the blue, then it fell below the red line. We had the rally, but it didn't go above that red line. So, if you look at the trend at the bottom, it's like dead in the water. That does not indicate any healthy uptrend is taking place. So the S&P has that picture too. NASDAQ is the only market in the United States and one of maybe 3 or 4 in the world that does not have that picture. The yellow line fell below the blue line, so okay, that's bad, that's called the death cross. We look at it to fall below that red line as the confirmation. Now, it's almost gotten to that red line. Not quite. So, and it's stuck. The trading is stuck right in that level. So, that yellow line still needs to cross. After that happens, every market in the U.S. is in bad shape. Now, the trend line at the bottom is really negative. It doesn't look good at all. So here's the Russell 2000. These are small caps. This is in the worst, market's in the worst shape. It has those 2 crosses we're looking for. The trading stayed below that red line. It's even stayed below the yellow line. And those 2 underlines. The first one is the low in that Black Monday. And then we've actually gone lower at the end of last month, the end of September. So that's extremely negative. That indicates, the bottom has not been put in. Maybe that's the bottom, we don't know. But it tells you for the other markets, the bottom has probably not been put in. And if you look at the trend line at the bottom, hold on. It's not circled, you see that black line's going down, that means the uptrend is lost its energy. Here's the dollar. The dollar's actually declining. The charts, technicals have been deteriorating for some time, very slowly now. You notice that yellow line is about to cross that blue line that was crossing it, so that's the first thing. At some point it has to cross that red line, that'll take a couple of months at least, maybe more. So people keep saying strong dollar, strong dollar, strong dollar. Well, no, the charts are saying the dollar is actually weakening. And at that bottom, that's a downtrend because the red is above the blue line and the black line is rising. That's not just a downtrend, but a strengthening downtrend, which means the dollar is going to go lower. Now, we actually should, okay, let's look at the euro. We'll go back to the DAX in a minute. The euro is the mirror image of the dollar. you see it's been beaten down. Well, the dollar's had a huge rally. Now, the yellow line has crossed the blue line on the dotted side. That's like a positive signal, and it's trying to head toward that red line. So the euro is trying to rally. If you look at that bottom, that trend indicator, it's a very positive uptrend picture. So the dollar's weakening, the euro's getting stronger. That makes perfect sense. One corroborates the other. So, let's go back to the German DAX. This is the top stock market in Europe. Notice it has those two line crosses. So it's just now is a bear market pattern. If you look at that bottom, the thing on the bottom, there's no nothing indicating an uptrend at all. The red line stays above the blue line, so it's not a weakening uptrend. There is no uptrend according to that. Okay, let's go to the Swiss franc is tied to the, well, they untied, it was tied to the euro, they've untied it. This is actually a currency worth owning, like the dollar or the euro. So, and this is trying to strengthen too. There's a very positive pattern. I mean, this is like something that really wants to rally. Now that black line is way too below the two colored lines. You know, it needs to get there and it's probably going to bounce down and then the real rally is going to start. That may be in another month or 6 weeks or something like that. But this looks like a chart, currency that really wants to go up. There's a FTSE, this is the British market. Notice this is really weak, that yellow line's below both of those lines, which are the blue and red line are together. So the trading is stayed below that. This market is very negative looking. These lines, if you see this, there was a double bottom. And the technicals, the RSI's on top, the MACD second, those got stronger as the price stayed the same. That indicates a reversal was going to happen and this rally was going to take place. And then the trend line, negative trend line weakened, also supported those other two. So that told you a rally is coming. It's not telling you a rally is going to last forever. These are daily charts. So, you know, we probably had the rally. Here's the Nikkei. Japan's a total disaster. But notice that the gold line has crossed the blue line. It has not crossed that red line yet. So this is one other market other than NASDAQ and actually the French market that we have not had that double cross. So we should be getting it, but the Japanese manipulate their market incredibly. And they do that by debasing their currency lately. So the downtrend line this is still in a downtrend. There was never any rally indicated by that circle on the bottom. The yen, you see, the yen looks like it's about to rally. This is something called a flat base if you ever go into IBD. And you actually see on that bottom, the blue line is above the red, that indicates a rally. And that black line has actually stayed sort of above that red line. This is something that's trying, it's a sideways movement. It's going to have, it looks like it wants to have a sharp move up. So that's what this chart is telling you. Now, if the yen goes up, the Japanese market will go down. They move in the opposite direction. So stocks will go down in Japan if the currency goes up. Shanghai, this is what started the market disaster globally. This is the composite. This is like the big market in China, the one that's least volatile. It's like the S&P 500 or the Dow. It's not like the Russell 2000, like the small caps. They have that also. So we still don't have that yellow line making that double cross, but the market lost 40% of its value. And usually that's like, you know, a major loss to begin with. And it's really horrendous. So, I mean, we still haven't got the bear market pattern. Well, 40% is a pretty bad bear market to begin with. And we still might get that bear market pattern, yes?
Yeah, but last year went up 100%.
It's in a bubble. Well, yes.
So it's really
And this cross can take place and it can go down 80%. Yeah, we're not, I don't think we're done yet. Not even remotely. You know, it might take 2 years or more. So, wait for that gold line may cross. Now, I said many times, and I've tweeted this a million times, the Chinese have done everything to hold the market up and push it back up. Everything. Including buying stocks, closing stock. They've stopped stocks and trading that were going down. They closed the market. They pumped money in. They created a fund to buy stocks. You know, you name it. And, you know, I tweeted one day, like, they've done everything but arrest sellers. And the very next day, they announced the policy of arresting sellers. Now, I tweeted that as a joke, but then the next day it became reality, which tells you what China is like, you know. the most outrageous thing can happen. So here's the Sensex. This is the Indian market. It's had that double cross, so it's like in pretty bad shape. India itself there's a number of problems there. So this is the bear market pattern. Notice though at the bottom, all those three lines are together. That means a reset is taking place. They either go up or down. It's like the trend is stopped for the moment. Russia is like a continual disaster. Low oil prices destroy Russia. So it's in a bear market. It's been in a bear market pattern way beyond this for years before this chart began. So the bear market is just continuing. Brazil is falling apart. They have a political crisis, plus any number of other crises. You can see that double cross, the two arrows on the right that we look for. Now that other arrow, that's the blue line actually went below the red line. That's something else you want to look for, but that's later on. That's like in a more advanced bear market. So, I mean, they even had that. So this is like certainly like a very confirmed bear market. And if you look at that circle in the bottom, that it's a uptrend happened, but the uptrend lost all its energy very quickly. So I wouldn't go long on Brazil. Oil, you must watch oil. Half the world revolves around what's going on in the oil market. Now we used to have Morgan Downey come here, who's one of the world oil experts, and he's on TV all the time talking about this. And he wrote a book, one of the books on oil. Now oil went to $38 like several weeks ago. It was 42 the spot price, and this is WTI, and went to 42 and then 38. This is incredibly cheap. It went to 33 during the credit crisis. Now what made this happen is the Saudis are overproducing by 2 million barrels. And they purposely drove the price of oil down. And they did this to bankrupt the U.S. fracking industry. And this is public information, it's not a secret. Plus it screws Russia, and they want to screw Russia too. Now Russia is going to screw them back. We'll just have to wait and see how that happens. And there's a lot of stuff going on in the Middle East. I mean, the Russians have moved into Syria, and they've moved into Syria with Iran. Iran is a major enemy of the Saudis. So like, Russia is playing footsie with them. And Iran's a major enemy of the United States, too. So, I mean, now they've combined forces. We left a political vacuum there. So this can affect oil prices, too, in the future. In the Middle East is a cauldron of, like, bad things that can always happen. And oil can skyrocket any moment because of that. Now, the Saudis actually said, we said that earlier, that one of the ministers said, though, the glut going to end. Well, they created the glut, so if this thing's going to end, that means they're going to stop creating the glut. So, and $38 is really cheap. The Saudis actually need like $80, $85, $90 a barrel to balance their budget. So, because they have a massive welfare state, they give tons of money away. It's all paid for by oil. So they're losing money. They're actually losing tons of money. So they can't go on forever. So look for a rally later this year in oil. And you can have a very significant rally, especially on the end of the year. The OPEC meeting is around December 1st, so there could be some announcement right around there. And it would leak out before. It won't happen just that day, like a week or 2 weeks before something appears. So on natural gas, this market's totally dead, and it should be, natural gas should be much, much higher. Frackers have been bankrupted. They stopped drilling a lot of oil. Some of those same fields do natural gas, but there still seems to be a glut of natural gas despite a lot of fields shutting down, which is rather curious. And the seasonal strong period for natural gas is this month, next month, last month, the fall. And natural gas is incredibly weak. It's like right around its production cost, or even less than its production cost. So this can't go on. This is some of the bottom price. Whether it goes up next month, I'm not saying that, but it's not likely to get cheaper. You just have to wait to when it's going to rally. Coffee, we've watched this for years. Around 20 is the low. It actually went lower this time. And it's starting to rally, starting to look bullish. Everything about this chart is starting to look bullish. The Australian dollar, this trades like gold. If the United States said you can't own gold anymore, you could actually trade the Australian dollar as a substitute. Now, it doesn't quite work one-to-one. You'd have to make some machinations and adjustments. but it tends to move with the gold market. So you have to like magnify the trade and adjust it. So this is, and I say this in my books, there's frequently substitute trades. If you can't do one thing, well, you can do another. So this has been very weak. It's currently gone 70 to a dollar. You know, in the credit crisis, it went to 60. So, but this chart's getting stronger. So this is a currency that's trying to rally. And if we look at gold is trying to rally too, which actually makes sense. You know, if one is rallying, the other should be rallying. This gold chart is starting to look very bullish. I mean, it actually broke above the 200-day moving average from the bottom. Hasn't done that in a long time. And we wanted to go above it and stay above it. It's gone above it once, as to stay above it. But all the other indicators in this chart are incredibly bullish looking. The bottom, that black line is about to cross that red line. That is actually a buy signal if it does. And this chart's a day old, so, and look at it, it's actually touching. So, and you know, it's a daily chart, so it's a buy signal for maybe weeks. You know, if it's a weekly chart, it would be a buy signal for months. So it depends on the length of it. But this chart looks very bullish. Gold miners, they've turned bullish too, which they should. They should actually turn bullish first. Notice that bottom circle, that black line, actually crossed the red line. So that buy signal already took place about 2 weeks ago. And notice there's a big rally that takes place when that buy signal took place. And notice that yellow line, which is the 50-day, that's actually turned up. The moving average itself is moving up. That's also a very positive signal. So silver, same thing. It also went above that 200-day. Yesterday, you see a buy signal. That black line actually crossed. The other two indicators above the median point, which is quite bullish. So silver is trying to turn bullish. And it makes sense. Silver, gold, and the gold miners should all be turning, and the Australian dollar should all be turning bullish together. And they're doing this. So people say what to buy and what to sell. You should stay out of stocks in general, unless they're commodity stocks. And you should be buying commodity somethings. So copper's been a big disaster. This has caused lots of trouble. It's been a bear market for a long time. Notice those moving averages are lined up. You know, the gold line is below the blue, and the blue's below the red. So this has been going on for years, actually. So it's trying to base. This does not look bullish like gold and silver and the gold and silver miners. That black line is decreasing. The trend is being lost. This is still quite trendless. There's no really bullish anything for this. And that's okay. Gold and silver and copper can move in different directions. Uranium, we look at this now and then. Uranium is unbelievably cheap, and it will have some massive rally at some point in time. I mean, it's getting a little bullish, but there's nothing really terrific like gold and silver here. So, you know, when it rallies, it will go up many times its current price. 30-year treasuries, bonds, this is the interest rate, not the price of the bonds. The interest rates have been they're sort of bearish. Notice that yellow line fell below the red line. It needs to fall below the blue line. Now the blue line should be above the red line, so the chart's all messed up. But yeah, if you look at the rest of the chart, everything's bearish about it. Notice that black line is very low in that circle in the bottom. The red is above the blue, which indicates a negative trend. But the trend is very weak. I mean, there's really no trend here. So you wouldn't go run and buy this or run and sell it right now. 10-year treasury, same thing. 10-year treasury is actually weaker, much weaker than the 30-year. You see it's below that blue line. The price is below the blue line, or the yield, sorry. And that yellow line is about to cross that blue line also. So that would be a bear market pattern for Merck. And you see that at the bottom, the red is above the blue, which is negative, and the black is rising, which means the negative trend is strengthening. Okay, that's it. Any questions? Okay.
Yeah,
I'll see if I have an answer.
I have a question on the government inflation index. The news is the news is saying that the Social Security cost of living adjustment is going to remain flat, 0 for next year. I guess it's the first time in many years. And the reason for that
it happened in 2009, I think.
Well, they claim the reason for it is because gasoline prices have gone down. But I thought the government excludes energy and food prices from the CPI.
When it's convenient.
So
Usually when it's not convenient, they exclude it when it's convenient.
So they're playing games with
And,
CPI.
oh, the numbers are all, that's why I wrote several books. You can't trust any of the numbers. And, we indexed Social Security in the late 70s when there was a lot of inflation. A lot of inflation we acknowledged. And then, I also said in this book, whenever government does this, they start finagling with the statistics shortly thereafter to make inflation go away so they don't have to pay. Now, the tax brackets were also indexed at that time. So the inflation numbers are totally phony. They're completely phony in every way, shape, and form. I see like prices go up all over the place, and then I read, oh, prices aren't going up. Just go to a store and shop. You'll see prices for everything. All the bills I pay are going up. I had a fight with the electric company like last week, because my bill was a lot higher than last year, and I said, how is this possible? Like the price of oil and natural gas are the lowest in 10 years, and there's oh, well, we of course, we have to, I don't know. There was no explanation. We could charge whatever we want to, basically. So, like, I see the prices of lots of things that I buy go up. The government just doesn't look at it. And they're motivated to lie. They save money by lying. And plus, if a politician says to you, wow, inflation's out of control and your earnings are actually going down and down and down and I've really screwed up, vote for me. Please vote for me again. Are you going to do it? You're going to say, no, you jerk, get out of here. But they say, look at this low inflation and how great your earnings are doing, and I've done an incredible job. Vote for me. You go, oh, okay. The public can easily be fooled. And I'll get to you in 1 second. And in Argentina and YouTube, they actually said that inflation rate was 10%. It was a couple of years ago. And everyone knew it was a lie. And on the street, anyone said, oh, it's really 30% the government's lying. So they were forced to redo the inflation numbers, and it turned out to be 50%. Now it's 5 times the rate they were claiming. So people knew, because the lie was so huge that, it was obvious that it wasn't 10%. Now here we're claiming, no, okay, maybe it's 2 or 3 or 5, 4 or 5%, and they're claiming like 0%. So like that you can sort of get away with, but anyone who pays attention says, no, this is not happening. And I have a friend who's like, obviously very neurotic. He put all of anything bought at the grocery store, the supermarket, all the expenditures in a spreadsheet, and he monitored it over time. And he said the prices were going up 10% a year. So that's just actual real buying. So the government's just lying. And it's not just the U.S., it's like every government is lying. So, okay, let me go to these two. You in the back. You have to talk loudly.
Oh, don't worry about that. First of all, in relation to your electric bill, that's why they call them con edits.
Oh, I actually don't have Con Ed, but they should call it Con Long Island. Con is right there, it's crooked as the day is long.
My question is, how do you see the relationship of your 10-year Treasury chart to the stock market?
Well, if interest rates go down, stocks should go up.
Sure.
But that may not be the case. The markets are all completely broken. And, we don't have it here, but in the last 2 talks or whatever, there were 10 countries in Europe that have had negative interest rates. Well, you can't have negative. In theory, you cannot have negative interest rates. It indicates a completely broken market. Well, stock prices should be infinite if you have negative interest rates. And they're not infinite. So, I mean, this theoretical impossibility. The system is off the, it's not within the box it belongs within. It's off the skid somewhere. So every relationship breaks down. It's like the relationship between the electricity that's running around a circuit and a wire and lightning. They're both electricity. Lightning doesn't follow those nice little rules that the electricity in the wire does. It does whatever it wants to do. So once you get out of that, nice world where everything is as it should, things just break apart and anything can happen. So the answer is, who knows? Yes?
Well, throughout your presentation, you mentioned a few different factors, such as with the market's going up and been recovering, yet food stamps have been going up and the unemployment rate's been
Well, people stop working.
You mentioned a variety of factors. Interest rates and QE haven't affected the economy the way that they should. And the conclusion that I've been taking it from just watching for a while seems to be that the issue is with the wages and in terms of distribution of equality. If you're looking at, if it's interest rates and investment aren't doing it, and there's really only three factors, and four in a GDP if you're looking at investment, consumption, government spending, and net exports. So net exports are always going to, and it's the U.S., they're going to be negative. Government spending, we're basically broke. So you're looking at consumption and investment, and basically the interest rate thing. It's at zero, and it's not doing what it should be, which would be consumption as the next area. But it's about, I work in wealth management, by the way. I've been following this for a while, but it's been looking like wages are kind of like the main issue that pulls all of this stuff together. So if you're looking at the real estate market, people are doing less mortgages. Food stamps are going up, employment, people are still unemployed. And it looks to me like it's really like we have a kind of a structural problem in the economy.
Yes, we'll talk about this later. This is too complex. I totally agree with you. Wages are a major, it's why it's become a major political issue with the $15. And I'm glad you brought that up. Where is that one? Right here, I'm going to mention your Australian story. The $15 is not going to solve anything. Because I was talking to this charming lady over there after last meetup, whose daughter lives in Australia. She's from New York, she lives in Australia. And the minimum wage there is $20 an hour. Now you would figure like, oh wow, the people who are at the bottom of the income chart are doing so much better because they're getting $20 an hour. Absolutely not. The prices of everything skyrocketed to adjust for that higher wage level. So they are no better off. But since the prices skyrocketed, the people above the minimum wage level now have to pay more for everything, so they're worse off. So the people who were supposed to help didn't get anything. The people, everyone else, got less. So it actually was a major negative. So this like idea, oh, you just raise wages, everything will be great. But I know that's not what I just wanted to make this point. But people's wages have been dropping, actually. Yeah. Real wages have been dropping. And that's actually a type of inflation. Inflation is you get less for your money. Okay, like you're getting this money, but you're buying less and less. And then go into any store, I mean.
The prices are going up.
Yeah. Well, I actually mentioned in my book, one of the books, and not all, did Kelly show up? This is a miracle. Okay, I see you there. The prices of things in 1950s, and like everything looks like they were free. Like a house for $8,000, a car for $1,000. Like a sack of potatoes for a few cents. It's like you're like, oh, wow. And this is like what prices were. Now they're like, you look at them now, inflation. Some inflation over many years can make prices go like astronomical. And the whole thing can fall apart instantly. The one thing about inflation, everyone assumes it's slow moving, and because it has been most of the time in the past. But it can actually happen overnight because we have electronic money. We have an entire electronic money system. Things could adjust like instantly. I've always maintained Japan is going to be the first country to collapse. They're just going to have a massive currency collapse. The debt is like way too high a level, very unsustainable. And it's just going to collapse in a very short period of time. So what's your question? We have to like.
It seems like the government and Federal Reserve are not going to raise interest rates.
Yes.
Rates are basically nothing. Plus, the government allows investors to deduct the money they borrow to invest. It seems to me that with all the problems with companies, all the problems in the world, still in America, people with money are going to invest in the stock market.
Well, that's where quantitative easing, that money goes right into the stock market.
And that's what's keeping.
That's why it makes the stock market go up and keep it. But interestingly, and we made this point in September. I wasn't quite awake, but I think I made this point. Well, I'm a night person, you know that. So, what happens? The quantitative easing is still going on in Europe.
Yeah.
They didn't stop it, and they pushed the market up last fall. The market's crashing everywhere, falling apart everywhere in the world. And this is the first time since quantitative easing began in 2008 that stocks actually went down while quantitative easing from a major central bank was taking place. So this tells you it's losing its effect. People have just bought too much, and bought too much. And we constantly use the heroin analogy. That, you know, you take some heroin, you feel great initially, then you have to, you know, take the same amount, you don't feel so good, you don't feel so good. You feel normal, then you feel crappy if you don't take that amount, and you feel really crappy. So to get the same feeling, you've got to have more and more and more and more heroin. So you've got to have more and more quantitative easing. So, and the Europeans have been saying, oh, we're going to do even more maybe. You know, we're still doing it, but we're going to add to it. Because they're trying to push the market up. That's what created that rally in the last, like, week, 10 days. So, but I think it's going to fail. You know, eventually all stimulus loses its impact because the system has adjusted to it. And this will eventually hit, maybe not now, although it looks like it's going to be now. And, you know, so, and it's fun, you know, you can't increase wealth by printing more money. You just have a lot more currency. You don't have more, you're not richer.
It just makes the stocks.
It's an
more
illusion.
expensive.
Yeah, but that's just like the Chinese market.
It's like real estate.
That was built on borrowed money, and you know they have huge leverage, and then it's all collapsing. You know, just same thing happened in the United States in 1929.
So you think we're
I think we're in
hitting
that
a reversal.
transition point now.
So you recommend cash or
Yeah, I think everyone should be for everything. Because like commodities aren't quite recovering yet. And, you know, if the stocks really collapse, they're gonna like just sit there and go down. Maybe not a huge amount, but so like you want to see what's going on. And David will tell you more later.